Good day to all, I'm Charmaine, iFAST Research Analyst. In a recent stress test conducted on the top 10 S-REIT by market capitalization, CapitaLand Ascendas REIT, CLAR in short, emerged as the star performer, showcasing unparalleled resilience in the face of the current interest rate environment. This finding positions CapitaLand Ascendas REIT as a beacon of stability and reliability for investors seeking a robust shelter in today's dynamic market conditions. The demand for CapitaLand Ascendas REIT logistic properties in Singapore remains consistently high, while the supply remains constrained. This sets the stage for positive rental reversions, further boosted by the prime quality and strategic location of its properties. The symbiotic relationship between demand, limited supply, and the strategic positioning of assets creates a favorable environment for CapitaLand Ascendas REIT continued success. One of CapitaLand Ascendas REIT's key strengths lies in its affiliation with a robust sponsor, which enables the REIT to secure loans at exceptionally favorable rates. This strategic advantage not only supports the current operational needs, but also positions CapitaLand Ascendas REIT for future acquisitions, amplifying its growth potential in the market. Additionally, it has demonstrated admirable financial discipline, maintaining a lower leverage ratio compared to its large cap peers, ensuring a solid financial foundation. As of the third quarter of 2023, CapitaLand Ascendas REIT boasts an impressive overall portfolio occupancy rate of 94.5%, surpassing its 10-year average of 90.6%. This stellar performance underscores the REIT's ability to consistently attract and retain tenants, solidifying its status as a preferred choice in the real estate investment landscape. Looking ahead, our optimistic outlook is reflected in our 2025 target price for CapitaLand Ascendas REIT set at $3.14. This valuation is derived from a dividend discount model factoring in a terminal growth rate of 2% and a cost of equity of 7%. The projected target price implies a notable 11.09% upside potential, presenting an attractive opportunity for investors. Furthermore, investors can anticipate an average forward dividend yield of 5.36%, enhancing the overall appeal of CapitaLand Ascendas REIT as a sound investment choice. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗪𝘆𝘀 will talk about Bitcoin ETFs. Over to you, 𝗪𝘆𝘀.
Hi, my name is 𝗪𝘆𝘀, iFAST Research Analyst. Recently, the US Securities and Exchange Commission approved the listing of 11 Bitcoin ETFs. However, in spite of the SEC finally approving these ETFs, the chairman of the SEC stated that the agency does not endorse Bitcoin, calling it speculative, volatile, an asset that's also used for illicit activity, and that investors should remain cautious about the myriad of risks associated with Bitcoin and products whose value is tied to crypto. So, taking this chance, we wish to reiterate and emphasize our stance that investors should stay clear from speculating in these newly listed Bitcoin ETFs or any crypto-related products. One of the primary concerns revolving around the lack of fundamentals and intrinsic value that traditionally underpin conventional financial assets. Unlike stocks or bonds, cryptocurrencies lack a tangible basis for valuation, making them susceptible to wild price fluctuations driven by sentiment and market speculation. This inherent volatility poses a considerable risk for investors seeking stability in their financial portfolios. Furthermore, cryptocurrencies face substantial hurdles when it comes to serving as a reliable form of currency. The sharp price volatility and limited scalability of many cryptocurrencies undermine their efficacy as a medium of exchange. This volatility not only complicates day-to-day transactions, but also diminishes the confidence of businesses and individuals in adopting cryptocurrencies for routine financial activities. The crypto space has unfortunately been tarnished by a series of scandals, frauds, thefts, and instances of money laundering. These incidents have raised significant concerns about the security and integrity of the entire cryptocurrency ecosystem. The lack of regulatory oversight, combined with the pseudonymous nature of transactions, creates an environment ripe for illicit activities, jeopardizing the trust and confidence of potential investors. So in conclusion, our view remains unchanged, consistent with the stance we've established since years ago. Stay away from these Bitcoin ETFs and crypto-related products due to the list of reasons mentioned above. Instead, investors should look to invest in assets with proper fundamentals and real earnings. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Jason will talk about Vital Energy. Over to you, Jason.
Hello everyone, this is Jason from Global Fixed Income team. Today I would like to share a bond idea called Vital Energy. Vital Energy is a small oil and gas producer with the oil fields in Midland and Delaware basins. The company daily produces 103,000 barrels of oil equivalent, with oil, natural gas and natural gas liquids accounting for around 48%, 26% and 26% respectively of its total production. In recent years, the company issued and placed new shares for equity financing for a few times, which could lower the leverage level and be favorable to its credit profile. The company's operating performance is significantly improved. We expect the free cash flow in 2024 will be the highest level in the company history. Assume a WTI at around 80 a barrel, the companies could record a free cash flow of around $355 million. This brings a higher visibility to its operating performance and also the credit profile. On the other hand, the company is increasing its oil to gas ratio. We could make it more resilient to the next downturn. Regarding the credit profile, as of September of 2023, the net debt to adjusted EBITDA and the net debt to free cash flow was 1.4 times and 7.2 times respectively. The leverage level is moderate. The interest coverage ratio remains high at 5.6 times. Overall, its credit profile is stabilizing. So thanks to its strong debt and equity financing ability, improving operating conditions as well as the free cash flow generated by the company's credit risk in the short to medium term should be under control. So investors could consider the bonds due on January 2028 with a yield to maturity of around 9%. So to get the full analysis, you can scan the QR code or click the link in the description below. That's summarized for today's sharing. You can catch us again next week for more investment ideas and updates. Thank you.